Record.
Good afternoon, everyone. You can hear. Hi, everyone. Please confirm if you can hear me clearly. If you can hear me clearly, go send a Y to the chat box.
Loud and clear.
All right, thank you.
Loud and clear.
Right, just give me a few minutes. Let me connect my laptop. We'll kick off shortly. All right. Only one person confirmed loud and clear. Please, the other persons, good afternoon. We are
Good
5 minutes
afternoon.
on. Yeah, please, if you can hear me clearly, you can, thanks for the thumbs up. You can also send a Y, just a Y to the chat box. Fantastic. All right.
Yeah, thank you. I've seen the whys. Thank you. So what we will do now, let me share my screen. So a little summary of our ground rules. To avoid the situation where some persons just join abruptly and you start hearing Oshodi, 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 or Abule Egba, we will mute everyone. When it gets to the point where we will interact, ask questions and interact just for the sake of a good order, or then you would be you'll be advised to raise your hands or throw your questions into the chat box. Then we'll mute you and we interact just for the sake of good order. So in case you find out that you're not able to mute yourself, it's me behind it, not your village people. So I will mute everyone now. All right. We start with an introduction of who is speaking with you. Today, we are here to demystify statement of cash flows, and the session will run in 2 series. Today is the first series. Next week, we would complete with the second series, so that everyone will be able to follow through and gain something tangible out of it. And the recordings and everything I project here will be shared with everyone after this call. So my name is Usidamen. Let me see if I can remove my video so you see my face here. My name is Usidamen. I practiced audit for about 8 years in the past before I joined the industry as the financial controller of one of the leading listed oil and gas companies in Nigeria at those times. And from that company, I joined another oil and gas company in the midstream refining space. Where I am currently, I lead and oversee finance in that department of that company. More than 13 years ago now, I used to be a prize winner with ICANN when I qualified, and even before I qualified as a chartered accountant. And since then, up till now, I've been teaching financial and corporate reporting for ICANN exams with ICANN students. I currently, although I'm on some kind of leave, but I lecture at Wise Associates Limited, and I'm one of the brains behind Accounting Yard. What we do majorly in Accounting Yard is just to bridge the gap between theory and practice. It's as simple as that, to bring more life to all the theoretical knowledge that you know or you have learned over the years, or to correct any practical knowledge that is faulty in your database or knowledge base. So that's what we do at Accounting Yard. And that's who I am. That's my face there. And you can also see my face from the fact that I've shared my video here as well. Moving forward here, I've explained who we are at Accounting Yard, a brand that bridges the gap between theory and practice. That's who we are. We try to correct and share knowledge as much as possible. Apart from even teaching, we try as much as possible to also share opportunities with accountants. We have a job group on WhatsApp where we share job opportunities on accounting and finance. So anyone who is interested in joining that group can hit any of the admins up. By hit any of the admins up, I don't mean you hit us. I mean send us a chat. We might have some Gen Z here, so I'm trying to use their language. So you can send us a chat. You can send me a chat as well. I'll share my number before the end of this series 1 and series 2 next week, Saturday. So this is where we start interacting. The program is on demystifying statement of cash flows. So I would start by asking you first, what are your expectations for this session? And to manage your bandwidth, I think I will just stop showing my face so I can manage the internet. So what are your expectations? You can throw them into the chat box. And if you would like to speak, you can raise your hand. I will unmute you, and then you speak. So let's start. What are your expectations for this 2-series knowledge sharing session? So if you like to speak, just signify by raising your hand. And if you want to just type in your expectations into the chat box, that's also fine. Mr. Osini Kazim, his hand is up. Let me allow him to unmute.
Yeah. Good evening, everyone.
Good evening, Mr. Kazim. Been a while.
My name is Kazim Kolawole.
Yeah.
I came across your program on Facebook, and by also looking through those tutors in accounting yard, I stumbled on my former tutor at WISE, Mr. Israel. So
Yeah.
I was moved that I must also be part of the this discussion this evening, and going forward, anywhere I am, I need also to join the discussions, because knowledge is power.
Yeah.
And the environment we find ourselves today, there's need to also share knowledge, so it can be beneficial in our place of work. And if anything is not clear, we can quickly bring it here. We are bringing practical experience to this place, so that every people can also contribute. How can we solve problems? Because we accountants, we are problem solver, supposed to solve the problem, that will reduce the cost or for the organization, and also increase their bottom line. So my expectation is to gain new knowledge, new insight that can also help me in my place of work, and also continue the networking. I know Mr. Israel must have known me.
Yeah,
May
sure.
God bless this. Thank you.
Yeah, thank you, Mr. Kazim. Good to hear from you again. Let me take Gil Pen. Then after Gil Pen, I will read some comments in the chat box and we proceed.
Okay. Good evening, sir. Good evening, everybody.
Good evening.
So I'm very happy that you're holding this webinar on this particular subject of the cash flow statements. So actually, my expectations from this particular webinar is that at the end, I will understand how to properly do the adjustments to the working capital and non-cash items, basically, because that is where my major challenge are when preparing the cash flow statements. Thank you.
Okay. All right. Thank you, Madam Gilpen. Let me look at some expectations in the chat box. To prepare, Madam Deborah Ike said to prepare SCF seamlessly. Okay. EA, I don't think it's Pastor Adeboye, but I'm seeing EA here anyway. To learn about the best techniques for statement of cash flows preparation from scratch. Oluade Adeni said, having broad knowledge on statement of cash flows and to be able to apply it on countless industries. Mr. Sunday, okay, Mr. Sunday, I've taken down your number. Thank you for throwing it in. I'll even send you a chat after this session at 6 o'clock. Blessing Nakachuku, I'll be able to work on SCF and balance it accurately on my own without the help of calling my manager. Madam Sandra, because I want to properly understand the remembrance. Okay, I think the Helios, my good old friend, to understand some of the technical adjustments, other cash payments and repayment on the operating cash flow using direct method. Okay, I think most of the expectations look the same. Most of them are the same. So let's see how much we can achieve. So wherever we stop in the 2 series is where we share the knowledge to, because we just have 2 sessions for this knowledge sharing. So the earlier we jump into it, the better. So if by next week we stop at Y, that is where this webinar will end. So the webinar is for 2 sessions, and wherever we stop based on our time is where we'll also end the webinar. But I'm sure we would have advanced to a reasonable extent. Thank you, everyone. I've skimmed through the expectations, and they are pretty much similar, and they look like things that we can achieve on this webinar. So let's look at the next thing. Yeah, just to also let you know that in 2 or 3 weeks' time, we are starting a training on preparation of management accounts. It's practical. It will be anchored by my good friend and colleague, Oladele Odugbemi, who is also one of the faces behind Accounting Yard. The price is there. We have made it as affordable as possible. Similar trainings will go for something higher, but one of our objectives in Accounting Yard is to weaponize accountants with knowledge and ensure that it's pocket friendly, because we know out there most accountants are not really paid as much, and we understand the economy we're in. So if you're interested in this training, you can send the chat to any of the numbers there, and this presentation slide will also be shared with you, so you can always send the chat to the numbers here. And if you intend paying directly, the link will also be provided in the presentation slide. That will be shared after the session. So let's just go right ahead now to the contents. Let's go to the contents. So the first thing we will be covering is understanding the statement of cash flows mechanism. So I use the acronym SCF a lot. SCF means statement of cash flows, not salt coming for or salt, curry, and food. No, it means statement of cash flows. So we'll be understanding the mechanism, basically. Secondly, we'll also be looking at the concept of cash and cash equivalents. So most of the times, when you see money in the bank, you think it's cash, but there is some principles, very simple principle behind identifying what is cash and what is not cash, and what is cash equivalent and what is not cash equivalent. We'll be touching on that. We'll also be preparing a statement of cash flows using what we refer to as the CAMPS framework. It's a framework we came up with to make the thing more logical. As with anything that you'll be learning for the first time, I don't promise that it will just be easy like that, but it will be something that brings more structure to your understanding of a statement of cash flow, so that anytime you are planting beans, by planting beans, I mean error. Anytime you are committing an error, you will be able to call yourself back and decipher the error. And anytime you also want to intentionally commit an error, you will know how to intentionally commit the error in a sensible manner. That's the CAMPS framework, something that puts more structure to your understanding of statement of cash flow. So many people don't have a back-end understanding of how the structure works. And then the fourth thing, if time permits, we'll just be talking about some common pitfalls that I, as a professional, have seen in a couple of statements of cash flows I've reviewed and worked on over time. So those are the 4 areas we'll be touching during this training. So let's start straight with the statement of cash flow mechanism, the mechanism behind the statement of cash flows. Yes, the mechanism. So before I go into too much talk about the mechanism, it's good for you to have an overview of what you will find in any statement of cash flows. So like the name implies, cash flow. Cash flow. For something to flow, is either it's flowing out or it is flowing in. If you go and stand by a river, you see how the water is flowing, especially when you go to the beach. It flows to the front, those heavy waves, and sometimes it flows backwards. So cash flow is not only water that can flow, cash can also flow. So it's either it is coming in as an inflow or it is going out as an outflow. And there are largely 3 sources of cash flow. So anytime you hear cash flow, there is this default mindset that one just programs and says, oh, anytime you hear cash flow, money is going out, because some of you have suffered too much debit alert in your bank statement to the point that anytime you hear cash flow, it means you want to pay money. No, cash flow is not only outflow, it can also be inflow when you receive your salary. or when you receive a remuneration for certain work you do. Cash flow, inflow and outflow. Number one source is operating cash flow. From the perspective of a business, operating cash flow is the cash flow you generate from the reason you set up the business, the core activity of the business. Accounting yard was set up to deliver training. Any money we get from delivering those quality trainings we do, it will go to operating cash flow. And any money we spend in the process of delivering those trainings, it will also go into operating cash flow as an outflow. So operating cash flow. Investing cash flow, on the other hand, we'll touch more on this. Well, investing cash flow is when you buy or you sell long-term assets, not just any asset, long-term assets. Sometimes they are called non-current assets. In the US, they often use the word long-lived assets. In those days, before the advent of IFRS, most times they usually call them fixed assets. So long-term assets, when you're acquiring or disposing those types of assets, you'll see them under investing cash flow. And then we have financing cash flow. Finance, like the word implies. If you want to, finance means that you want to raise money for something. Yes, it's recorded, Mr. Abdulaziz Abdulwahab. It's recorded. So finance means you want to raise money for something. Think about it. Put yourself in the shoes of whoever wants to raise money. If you want to raise money for something, there are two means. It's either you get someone to lend you the money or borrow, or you, by your own self, you take the money from your own pocket. Maybe you want to build a house. So it's either you get maybe a bank to borrow you or lend you the money to build the house, or you use your own money. So when you borrow money from somebody else to do something, it's called debt. And when you use your own money, or when somebody gives you money that they don't intend collecting back, it's called equity. So there are two forms in which financing cash flow can come in or go out: through debt, when you borrow money, or through equity, when you spend your own money or somebody gives you money and does not intend collecting the money back. We always like that one. In Nigerian parlance, we call it a dash me money. That person has given you equity. He has added equity to your life. That person has invested in your life. So you should thank him well. Financing cash flow. So by the time you add these three sources of cash flow together, you then have what we call total cash flow, or when we get to the statement of cash flow, changes in cash and cash equivalents. Those are the three things that have made your cash and cash equivalent, your cash balance, to change between last year and this year. So instead of total cash flow, sometimes or most times you will see that line called changes in cash and cash equivalent. So if you add it to what you had at the beginning, it will give you your closing cash balance or cash and cash equivalent. So this is just a bird's eye view of how a typical statement of cash flows work. We'll prepare it, so don't worry. Just continue following me closely. Follow me so closely that when I look back, my nose will touch your nose. Follow me that closely. So any of these figures can end up being negative, and it is not abnormal. So don't open a cash flow statement or a statement of cash flows and you are seeing a negative operating cash flow and say, yeah, this is abnormal. Israel told us, what Israel told us, the X there was a positive X. Oh boy, the thing can also be negative. And there's nothing wrong with that. So if either the opening or closing balances is negative, it means that the business has what they call an overdraft. And you will agree with me that overdraft facilities are very much available out there when you are trying to run one or two as a company. So bird's eye view, take a bird, let it fly over the statement of cash flows. This is what the bird will see. An eagle, not a bird that does not see well. So an eagle is what the eagle will see, sharp, for a statement of cash flows. So now let's go further into the mechanism. There is a way I see statement of cash flows I've not read it that way in any book. I came up with that understanding by myself, and I've taught every student that's gone through me or passed through me using that same system every time, and it works. It makes you see it with more, logic and more sense. It brings life to it, not just cramming. So this is where I always like to start from. It all starts with an idea. Please, if you have not been following me before, start following me now. Leave that eba. I'm seeing you rolling eba in that sitting room. That eba that you're rolling, yellow eba. Drop it and listen now. Leave that eba. Leave Chelsea alone. May God help them to win or lose. I hope there is no Man U fan here. The ones praying for Chelsea to lose. Leave Chelsea alone. Focus. When you want to start a statement of cash flows, or you want to start understanding a statement of cash flow, remember that this whole thing that you are doing starts with an idea. Put yourself in the shoes of the company. Say, for example, you have an idea that you can sell water to people out there. That is an idea. Or you can sell books, or you want to start Uber business. Some people have their videos on. Please off your video. You want to start an Uber business. That's a good idea, right? But like some musicians will say, they will say, "Na money be fine, bobo." That means it is money that makes a person more handsome or more beautiful. So money is important in the scheme of things. They will say love without money. How did Davido sing it? He said, when money enter, love is sweeter. This is your idea too as well. If you want to bring life to it, you need finance, you need money. So that's why we want to say, let everything start with what? With an idea. And I love the way Napoleon Hill put it. He said, the ideas are the beginning of all fortunes. Everything you see out there started with an idea. So what did I say? It starts with an idea. All right, you now have an idea. You want to sell a bar. You want to sell ogbono. Good idea. The next thing, you need money. So the first point of understanding the mechanism is why I start with what they call the bottom-up mechanism. The bottom-up mechanism behind understanding the statement of cash flows. What we are doing now, we're not talking about preparation. We're talking about making sense of it and even analyzing it when you see one. Because beyond preparation, you should also be able to make sense of a statement of cash flows. So bottom-up mechanism. Financing. Remember what I showed you earlier? Operations was the first, investing was the second, and financing was the third. And that's why I call this the bottom-up mechanism. So I'm starting from financing. Remember we said something, it starts with an idea. So when the idea comes, that spark in your head, you need money to fund that idea. And that's where financing comes in. And I believe this is where the story of statement of cash flows, it should usually, I feel it should always be told or explained from the financing standpoint. But instead, the statement of cash flows is shown, upside down as far as I'm concerned. So from financing, you have an idea, you need to fund that idea. So secure the financing needed to fund the idea. If you want to expand, let's say it's an ongoing business, you want to expand your capacity, you need finance to expand your capacity. You have a strategy that if you sell to a certain market, you would make more money. You might need finance to push that strategy. So the first story starts from where? Financing activity, the need to fund the idea. Don't get me wrong, sometimes the idea can be funded from the money you have made from the business in the past. We'll come to that shortly. Let's even assume that this is a new business. You need to fund the idea. There are two ways you can fund your idea. I mentioned them earlier. Either debt, that means you're going to go and borrow money, or equity. That means you use your own money, or somebody gave you money and said, "Oga, that should have money. I'm not going to collect it back, but you might be paying me dividend in some years." So when you go in search of money like that and you raise those monies, what you are engaging in is financing activity. Remember, it starts with an idea. You need the finance to fund the idea. There are two ways you can raise the finance. Either I go and borrow money or somebody dash me money, equity, and said, I'm not collecting it back. However, you go pay me dividend. Or even myself, I take money from my own pocket to fund the idea. That's also equity. So the bottom-up mechanism starts from financing after you have such a good idea. Let's assume you have raised the finance. The next thing, when you raise the finance, you will not just be looking at the money in the bank and say, yay, thank God, oh, I have money. Oh. Some reckless businessmen will take that money and spend it lavishly. But we are not talking about those type of businessmen. We're talking about real people that need money to develop the space they found themselves. So that money that you have raised, either debt or equity, you now need to invest it in the idea. Most of the times, that idea will require you to purchase an asset. That strategy will require you to purchase an asset. And that is where the investing activity comes in. At this point, you are taking the money you invested in. I mean, you raised and you are investing it. Think about what Dangote did a couple of years ago. He had an idea. He wanted to set up a solid refinery. He went to get the funding, billions of naira, millions of dollars. When he got that money, what did he do? He did not go and squander it on a party. He used it in constructing and developing that refinery, which is an asset. So the effort of constructing and developing that refinery is an investing activity. The effort of getting the required money from the various investors is a financing activity. So that's the second part of statement of cash flows. Investing. You have to invest the money that you have raised. Don't use it to do O and B. You use it to invest in the idea. Mind you, sometimes the idea, the expansion or the strategy may mean that you might sell off some assets, and it's also part of investing. So if you sell off some assets as well, you're also engaging in an investing activity. It's not compulsory that you must acquire before you are investing. You must also dispose sometimes because remember, it all starts with an idea. Start with an expansion strategy. Start with a strategic plan. They could be in the boardroom and somebody just came up with one stuff and said, let's do this thing, this. And from there, we're looking for the money to fund it. From there, we are buying assets, we're expanding, we have moved into investing. So we have raised the fund, we have invested it in the asset, or we have disposed certain assets. The next thing, we have the asset. Once the asset is on ground, once the refinery came on ground for Dangote, he did not just lock it up and say, okay, thank you, refinery ready, everybody can go. No. The next thing Dangote did was to operate the refinery. So that means the next work stream in the mechanism is operating. And that is why we have what they call the operating activity in the statement of cash flows. So with the assets you purchase, you put that asset to work to generate income, turning assets into business profits. This is the bottom-up mechanism behind statement of cash flows. I'm doing this because I don't want you to see statement of cash flows as some documents where you prepare. You should have an analytical mind towards the mechanism that's playing out in that document. This is the bottom up, from financing to operating. Start with an idea. Raise the fund for the idea. When you get the fund, invest it in an asset. Sometimes the idea could be that you want to dispose of some assets, maybe because those assets are not profitable. It's also an investing activity. But when you acquire those assets and they are now on ground, you must operate them. And that is where the operating activity comes in. You will agree with me that if that idea fails, everything crumbles. The cookie crumbles, like they will say. And that is why the operating activity is the backbone of everything. Everything sits on it. Everything is the foundation. So this is the bottom-up mechanism from financing to operating. We have started operating the asset. The next thing you should also now consider now is now the top-down mechanism. The top-down mechanism. That's the next thing. Operating. You go back to operating. You know, we're now in operating. We started from financing, moved to investing. We moved to operating. Now we are now operating the asset. The operating activity should generate enough net cash flow to fund expansion and reward providers of finance. That is the whole essence of if you say your idea is so good, you have put money in it, then the idea should be able to make money. If in the future you intend expanding beyond where you currently are, if, for example, you produce 20,000 units every day, per day, that's your capacity. You have looked at it that, 5 years after, you want to expand. If your operation, if your idea is that solid, it should be able to fund that expansion. It may not fund it fully, but it may contribute to the funding. So that is why the first line there for an operating activity, after you have operated that refinery, after you have operated that Uber business with those cars that you bought, if you want to expand it from 10 cars to 20 cars, the monies you have earned on the 10 cars in the past should be able to support your expansion. Apart from that, remember that some people gave you money to do this business. You must return their money. You should be able to reward the providers of finance, even those that dash you money. Imagine somebody that dash you money to do business. The person's daughter is now doing wedding. They invited you. You said, bullshit, man, I can't go, man. You said, bloody hell or whatever it is. Yeah, you'll be an ungrateful person. It is you, that is supposed to be there and scatter that place with money. Money from the operating activity. That's on a lighter note anyway. So you must give back to the providers of finance and fund expansion. The expansion funded through operating cash flow may not be 100% funding, but the operating cash flow should at least be capable of supporting your expansion idea. Investing. So when you're looking at the investing activity now, after the company has kicked off, operations have started, at that stage, it will be rare for you to find the company disposing assets anyhow. Because the idea is that if they dispose assets, what they want to use to make money, what would they want to use to make money? So anytime you are looking at the company statement of cash flows and you are seeing that they are disposing assets, it should be signaling to you that, what is happening here? Do these people want to change their strategy? Because you already understand the cash flow mechanism, that it is assets they use to generate money through operations. So when the company is disposing a major asset, look out, scan well and find out what the shift in strategy is. Or maybe they bought new assets to replace the old ones. That is the investing activity. Another thing with investing activity is that, I mentioned something that the assets will be used to, the assets will be operated rather and used to generate operating cash flows. There are some assets that are not used in operations. Instead, those assets generate what they call investing cash flows, e.g., interest, dividend. Let me give you an example. A company might have made so much money from its operations, so much money, and is looking at, I have surplus cash. Where can I put this surplus cash? And I don't intend expanding yet. The company can take that money and invest in somewhere. Maybe invest in the shares of Sterling Bank that they are recently, publicizing. Any dividend, for example, accounting yard invested in the shares of First Bank or Sterling Bank, as the case may be, or Wema Bank, which we are hearing that is undervalued now, or Wema Bank. This is not an investment advice, so that's just discussion, by the way. Or Wema Bank invested in those type of investments. The dividends you are getting from it will come under your investing activity as well. Even though that money you spent on Wema Bank is not used in teaching people in the class, it is not used in generating operating cash flow, but there are some income from that investment. Such can also be termed investing cash flow because there are some assets that are used in operations and there are some assets that are not used in operations. Then, after you have maybe taken some money from operations to fund part of your investing, remember, some people are waiting for you. Maybe you have now made money. The money we gave you, pay us back, repay your debt. I invested equity in your business, pay me dividend. All these demands are on the operating cash flow. Oh, I want to expand. I can still go further to get more debt or more equity. So this is the mechanism behind the statement of cash flow, starting with an idea, raising the finance, investing the money raised, and operating the asset. That is one end. The next end, when I start operating the asset, I should generate enough cash flow to fund expansion in the future. I should generate enough cash flow to give the people who gave me money, I should be able to return their money to them. I should be able to pay dividends. And I should be able to find myself in a position where I can even ask for more finance from people who are lending me and so on. So that's the mechanism I want you to have at the back of your mind when you hear statement of cash flows. The bottom-up mechanism and the top-down mechanism. Before we bring the pieces together, I want to pause so we take some comments, some questions, some contributions. So if you have any comment and you would like to speak, please signify by raising your hand. If you have any comment and you are too shy to speak, the chat box is there for you. Throw it into the chat box. Any comments? Okay. Chidima Ezo. I hope I pronounced that well.
Yes, please. Good evening, sir. Thank you for the lecture so far. Yes, it's been quite interesting and engaging. So my question is, while you were mentioning, like investing activities, you gave an example. You said that selling off or disposing an asset, right, is also a form of investment. So my earlier idea used to be when you dispose or when there's a disposal of a long-term asset, right? That is like a divestment activity. So I'm trying to connect it to how does that also fit into an investment? Is it like the money gotten from the disposal will be used to like buy back or buy an asset or something? I don't know. So I just wanted you to help clarify that area.
Thank you for that question. Please don't mute so we can engage. That's a very good question. And I'm happy we are thinking of this thing from a strategic standpoint as well. We are not just being characters. Now, divestment, like you call it, is clearly an investing activity. And that's why it was signaled here that you need to pay attention. Why did they sell that major asset? You could check their director's report or you could check their commentary. There are some areas before the real financial statement where the companies do a lot of explaining of their strategy and whatnot. So you could read through that aspect to find out why they disposed the major asset. It could be that, they are not interested in that line of business anymore. They want to move elsewhere. For example, some years ago, surprisingly, Forte Oil, Femi Otedola divested from downstream and he left the downstream sector and focused more on power industry. He had his reasons. I think he even released an interesting book recently about his ordeal along that line. So it's not a one-fit-all answer. It's for the reviewer or the analyst to dig in further into the annual report to find out why that thing was disposed before you go and advise somebody to invest in their shares or before you take any other investment decision. So it might not be casting. So it's an investing activity, but you need to inquire more about why that was. Now, it could be that they dispose it because they want to change strategy to maybe leasing instead of outright ownership. So it could be, a lot of things. Yeah.
Okay. So I get it now. So it's like you're kind of disposing that asset, but still trying to like plunge it in. So it's not as if to say you're closing down the business outrightly, right?
It may be, that's why I said that you might need to dig down into the annual report to find out why. It may be that they want to close down and say, oh yeah, we're not doing again. Some years ago, Procter & Gamble, they sold off one major warehouse or factory in Ibadan those years, and it was a major one. So it doesn't mean that they want to, well, maybe it meant that at those ones wanted to leave the country, just like ShopRite too also left some years ago. By the time you now check ShopRite's statement of cash flows, you will find a divestment. So it's always about just know the things that should ring in your head when you're looking at the statement of cash flows and you drill down further. In financial analysis, when you see such, you need to analyze further and drill down further. Financial analysis is almost like audit. That's what some people don't know. So when you're analyzing the financial statement and you see something that caught you off guard, drill down and find out what that thing is about. So it's not necessarily that they want to run away, but you must drill down, bottom line. Yeah.
Okay, so please, I still want to gain like further perspective on this because I just feel like, even according to IFRS 5, right, asset held for sale or discontinued operation, right? So when a company decides to dispose of, let's say, a group of assets or an asset, so you know that one of the criteria is that it will be recognized after that disposal. So if an asset after being disposed is derecognized, so how is it still bringing in investment income or bringing in inflow into the business? I don't know if I'm just imagining things, but I'm just trying to like understand and piece it together.
Good. Albert Einstein said imagination will take you all over the world. He said imagination is a good thing. It's good as you are imagining. So the answer is just straightforward. If you dispose of an asset, you are not expected to be generating any income from it. So if you're analyzing a financial statement and you're still seeing them generating income from a disposed of asset, it's another reason for you to dig deeper again.
Okay.
Yep.
Okay. Thank you. Thank you very much, sir.
Thank you for that question. Let's take one more person online, 2 persons from the chat box, then we fire on. I will just call your names. It's not like I'm seeing names and I like one name over the other name. Any person that raises in the order of how quick or how early you raise your hand. I'll start next with Mr. Babatunde Adegbola.
Hello, good day, everyone.
Good day, sir.
Yeah, how are you doing, sir?
Great. We thank God.
We can't appreciate you enough for this exercise, and we can only pray that God continue to renew your strength.
Amen. Thank you.
What I'm going to add to the question our lady asked just now, in my opinion, is the fact that I stand to be corrected though. The asset you're talking about, in the first instance, has been captured as an investment. What do we call it again? Has been captured as as an investment. Hello.
Yes, we're with you.
Yes, has been captured as investment in the investment activity at the first instance. Am I right?
Yes.
So if it's also going out now, it's going to come out from the same investing activity.
Yeah.
So whether plus or minus, it's leaving the house where it was before. So I think it should be recognized as an investing activity. Then on the other side to it, in my opinion, is the fact that even if an asset is disposed, whatever, whether they're continuing with it or not, I think money would have been received with respect to the sale of that investment. So once it's leaving one area of a cash flow, I think it's going to come in from another angle in form of cash. I don't know if that is correct. That is my input here, sir.
Yep. Thank you very much. I think I very much like the first thing you said. It even reveals what we usually call matching concept, even inside the statement of cash flows. Mr. Adebola said that the same way the initial acquisition came in through investing was the same way it's going out through investing. I like that. That's very good. Thank you very much, sir. Yeah, let's look from the chat box if we'll find any question. Mr. Adewale Oderinde said, please, when a firm finances its asset through lease, under which heading will it appear? Thank you. Well, it depends. You know what? I'm going to park this question. We'll use it to test ourselves when we go through all of this. So I'm going to come back to this question. Somebody should please remind me. We shouldn't forget. It's a good question. Okay. Thank you, everyone who has thanked me on the chat box. I am grateful. Thank you. Ibrahim Yusuf said in an interview, I was asked which part of cash flow was the most important, and I didn't know what to say through, though I later said investing is actually the operating, as far as I'm concerned. The operations is the backbone. Everything sits on it. It crumbles, nobody gets money. Investment fails. So that is why, as you will see when we proceed, the operating activity has two methods for presenting it. The investing activity doesn't have two methods, just one method. The financing doesn't have, they celebrated operating by ensuring that it has two methods. So that's to tell you that the operating activity is more or the most important of the three of them. If it fails, yawa go gas, like we usually say in Nigeria, there will be problem. Okay. That is, don't forget, the bottom up, starting with an idea, and the top down, you using your assets, you operating your asset, like Dangote is currently doing, fighting with everybody. He doesn't want that money that he has put in to fail. That's why he's doing all those things, apart from whatever national well-being is involved. We bring the pieces together now. We understand that it starts with an idea. We understand that we will raise finance to fund the idea through debt or equity. We understand that when we raise the finance, we will now go and buy the assets. Don't mind my English. I'm trying to use the kind of English that we understand. Well, I'll try my best not to blow grammatical blunder. We invest it, then once we buy the asset, we operate the asset. If we start from that perspective, when you want to bring the pieces together now, you would now want to have a bird's eye view of the typical type of cash flow you will find under financing, the typical type of cash flow you find under investing, and the typical type of cash flow you find under operating. Because once you understand this thing and you pick up a statement of cash flows and you are seeing repayment of debt under operating cash flow, maybe principal repayment of debt, you will put them on inquiry and say, something is wrong here. This is not what I understand. When you are paying the principal on a debt, it's usually, if it's not a financial institution, it usually come under financing activity. Or when you have that mindset, you can easily puncture whatever nonsense has been done or wrong treatment has been done in the statement of cash flows. Now, let's start from financing. Let's bring the pieces together. Remember, bringing the pieces together is having an idea of the typical type of cash flow you will find under each of the three categories, such that when you are seeing a stranger in a particular category, you can easily pick it out. You can easily pick it out. By stranger, I mean a wrong treatment. We start with financing. Given what I have said, now I want to test whether you are following me indeed. Given what I have said, if I'm looking at the financing activity of a business, what are the type of cash flow that I will typically see? What type of cash flow do you think I should see? Remember financing, I went to go and borrow money, or I went to go and get equity. Somebody dashed me money with promise to pay them dividend in the future. So what type of cash flow should I be expecting to see under financing activity? Let me see the chat box. Loan, exactly. Loan. Somebody said loan acquired, issue of shares. Those are the things I should be seeing. If they bought an asset and I'm seeing it under financing activity, oh boy, there's beans there. I will move back again and say, who planted this thing here? If I ignore it, that means I'm watering the beans. I must do what? Uproot the beans. So thank you very much. Financing activity, the typical cash flows you find there, the cash flow from securing the required funds. Loan, like some people said. Remember, loan is not only the only form of debt. There are other forms of debt. There is bonds, which is one of the most popular. So loans is more private. Bonds is more public most of the time. We have debt and we have equity. That means somebody has given you money with the promise that you will pay dividend. That's equity. When you secure the funds, you must also pay the money back, especially if it is debt. So under the financing activity, you'll be seeing principal repayment. You also find interest repayment, payment of the interest on the debt. And I put a footnote there. You see that one there. It's just a signal to tell you that interest paid can also be found under the operating activity. So if you find interest paid under the operating activity, is not abnormal. The reason why some people have advocated it to be treated under operating activities so that they will see how strong the operating activity is. Remember the whole idea, everything we are doing is for operating activity. So if you put interest paid under operating activity, you will be able to demonstrate, see it at a glance, how strong the operating activity is to pay the interest on the debt. So that is why alternatively, interest paid can also be presented under the operating activity. Dividend paid as well. Something similar to dividend paid too. Some also advocate, which the standard IAS 7, the accounting standard related to it, allows. Dividend paid can also be found under operating activity, but most times you see people put it under financing activity. So you can see the nature of all these cash flows here. They mostly relate to, I collect money from people. I pay the people back. I collect money from people to run my business, to invest, do whatever I want to do. I shall borrowed money from people or I, got equity from people. I pay their money back. I pay them their interest back. I pay them their dividend, the ones that I promised that I got equity from. You see that those are the type of cash flows you find here. So that when you are looking at a statement of cash flows and beans is hidden there, you can unplant the beans. The next one is investing. So again, given what we have said so far, what kind of cash flows do you think you should expect under investing activity? Please feel free to chorus it in the chat box. Remember what we said investing activity is? Borrowed money or whatever you got money from, you now invested it in what? Long-term assets. I'm seeing some people putting asset there. I'll give you half mark. When you are talking about investing activities, you are not even talking about only PPE. I'm seeing Mr. Raphael Christopher say PPE. PPE is an example. When you are dealing with long-term assets, then you are dealing with investing activities. So when you purchase or when you dispose long-term assets, those are the kind of things you will find in investing activities. Thank you, Madam Freki Umo. Buying shares of other companies is an example as well, especially if that is not your core business. Remember that some people, their core business is actually buying shares. Those type of people, it is not investing. Instead, it will be what? Operating. So let's take note of that. So the idea, the nature of the business, that's why I say it all starts with an idea. So buying shares for a company that is not an investing company most likely will give rise to investing activity. So acquiring new long-term assets, disposing old long-term assets, interest and dividends received for assets that are not utilized directly in operations. Remember I told you that there are some assets that you will buy. You don't use them in your operations. You are holding them for investment purposes. So if you get interest from them, or you get dividends from them, those type of assets, they come under investing activity. However, if you are dealing with a financial institution, interest received is most likely an operating activity because that is the business of the bank. That is their operations on a day-to-day basis. So you might find interest received under operating activity for a bank or financial institution. But for a company like maybe accounting yard, interest received will most likely be under investing activity since our core business is delivering training. And thirdly, operating activity, monies received from customers, cash paid to suppliers and employees, tax paid, interest paid. Like I mentioned, interest paid can come under operating or financing. As we'll see much later, there are two methods for presenting this, where we'll now be talking about adjusting for working capital and the likes under what they call the indirect method. But the first method, it's always good for you to stumble on, is the direct method. That is the method that is encouraged by IAS 7, the accounting standard that governs statement of cash flows. But what we find in practice is that the indirect method is often used. And the reason the indirect method is often used, we'll talk about it when we get there. So if we bring the pieces together, like I mentioned, interest paid can be under financing or operating. Dividend paid can also be under financing or operating. Remember, those cash flows are under operating so that you can demonstrate how solid, how strong, how quality your operations are in generating so much cash flow to cover these important monies that you need to return to those that provided finance. And the third thing, financial institutions will typically present interest received under operating cash flow. So when we pull the pieces together, this is what you will find for each of the various activities. Let's take a brief pause again to take questions. I think Mr. Issa had his hand up earlier. It's time to unmute him so he can speak. If you also have questions and you are shy, like I mentioned earlier, the chat box is there for you. So let's start with Mr. Issa.
Hello, sir. Good afternoon. Thank you for the wonderful session so far.
Yes, sir.
My question is on the equity, the financing activities side of things, on the share capital. Some months ago, when I was preparing AFS for a particular company, so my unit head, because the company is a new company, so I introduced the share capital. That's the share capital that was issued in the cash flow. So he asked me to remove it, that there is no evidence tracing back to the bank statement, that usually in Nigeria that most companies, they just declare it on their CAC, and they don't have that 1 million share capital. But based on my understanding of cash flow, the share capital will just is something we're supposed to like show in our cash flow statement. I don't know, because it's a bit confusing as to I'm supposed to show share capital, but I'm also taking it out because it doesn't appear in the cash flow. Can you just like shed more light on that, or like an explanation on that, sir?
Yeah, thank you for was it your manager who called you to order? Oh, you have admitted. All right, so to address his question, what he's saying is when a business is set up, you would do the typical incorporation with the CAC. If it is 1 million shares you want to put there, you put 1 million. If it is 10 million, if it is 5 million, depending on what you want. Now, for the sake of explanation, let's assume that what you did with the CAC was a 1 million share capital business. At that point, you make the necessary payment to the CAC. The CAC will issue the necessary certificate to you with the names of the shareholders of that company. What that now means automatically is that if, for example, Israel registers and incorporates a business of 1 million units of shares, it means that Israel now owes that company 1 million shares. 1 million naira rather. So Israel must pay the company 1 million naira for the shares that the company has given him, as evidenced by whatever happened with the CAC. So what happens at that point, if your double entry is still sharp, the company will debit receivables due from shareholders or shareholder, this case, Israel. And at the same time, the company will credit share capital. Are they being, like that lady in that skit that went viral, are they being this debit? Don't mind the English, it's just on purpose. So it's not like I don't understand English. Are they being that this debit went to cash? It would have appeared in the statement of cash flows as issue of share capital. But because it is still in receivables, it means that the company has not received that money yet from Israel for the shares that the company gave to Israel. Remember that the company is also a person, an artificial person. So that was what your manager was trying to say. That in the books, that shareholder has not paid. It is still hanging in the books as a receivables for the shares it took up. Therefore, you cannot have an issue of share capital inflow. What goes into financing investing most times are actual cash flows. So if the cash does not come in, you cannot find it in the statement of cash flows. So that is why it will not appear under the statement of cash flows until that shareholder eventually pays for it. Let me see if I can unmute Mr. Isa to see if we have been able to answer that question.
Oh, okay. I think that this clarifies why it wasn't it won't appear in the cash flow. However, he mentioned that most times that nobody pays for share capital, that should just take it to pre-operational expenses and expense it out. I don't know, is because
so what is happening is this. I don't want to ask the age of your manager. I'm most likely somebody old. So in interacting with most of the older folks that knew, it's not wrong, but if you look at it in accordance with IFRS, it's not the way IFRS wants it. So what is applying is the defunct SES. In those years, those type of costs will be capitalized as pre-operational, and I think they usually spread it over 5 years. I'm even sounding old right now because I also practiced that a little before IFRS came and said that under IS 8, if you have a pre-incorporation expense, you should expense it, except if that pre-operational cost has any asset in it. Because sometimes you might buy some assets in the process of setting up your business. But if there are no assets in it in accordance with maybe IS 16 or the likes, right, that cost should be expensed. So if the account is being prepared under ICS, he's correct. But if the account is being prepared under IFRS, he's not correct. It cannot be capitalized. It should be expensed. That's pre-operational costs. I'm not talking of this share issue.
Okay.
Let's get it clear. There's pre-operational costs and there is this receivable due for share issue. I don't know if you get that. It's not difficult to. You have incorporated the business.
I'm confused though.
No, it's not difficult. No, it's not that difficult. You have incorporated the business, right?
Yes.
The business gave you shares. That's share capital. That's different. Pre-operational cost is saying that, okay, after I've incorporated the business, I bought car. Or before I incorporated the business, I bought car. I paid for audit fees. I bought tissue paper. All those costs you incurred before you incorporated the business, they are pre-incorporation costs. They are different from the shares that the business gave you through CAC. You get it? Yeah.
Yeah, I think I get it now.
Yeah, so when he's talking pre-incorporation costs that you should capitalize it and spread over 5 years, that is what he's talking about. But when you're talking about the shares that the owner took from the company through CAC, that one will pass through receivables due from shareholders, and we'll be expecting him to pay through cash or kind. Don't let us digress. That's already outside the statement of cash flows. Yeah.
All right. Thank you very much, sir.
All right. Let me see one question from the chat box. I'll take one question again from the people that are available. Madam Grace is saying, are you saying the 1 million shares we have on CSC registration should not be treated under financing activities? No, that's not what I'm saying. I'm saying that it will only appear on the financing activity only when the shareholder pays for it. That's what I'm saying. If the shareholder does not pay, remember, it's a statement of cash flows. So if the shareholder does not pay for it, it cannot show under financing activity. It will still be hanging in your receivables. That's my point. I would like to unmute Madam Grace and hear her speak. Madam Grace, are you somewhere you can speak?
Yes, I can speak, sir.
All right. Do you understand my second explanation?
Yes, I actually understand it, but in reality, most of those shares are not usually paid. And me, practically, that's what I've been doing. I've been putting it under financing activity. So that means I've been doing the wrong thing all this while.
I don't want to say that you have been doing the wrong thing, but you have been doing the wrong thing.
Wow.
Yeah.
So what you are saying now is that we should put it under receivable as what, sir?
So it will form part of your, there's a line under operating activity called adjustment in working capital. So that movement in working capital, that's where it will continue to hang until they eventually pay for it.
Wow.
But this is what happens most times. Those guys actually pay for it, but they don't pay. So it's not compulsory that they pay for it in cash. They may pay for it in kind.
With the cost of starting the business, right? Those funds they bring in personally.
Yes, those type of things. Those are the things you can use to liquidate it.
Okay.
You can also use that. But once you're liquidating it, let them know that clearly this is what we are doing to your receivables. And this is why you no longer owe the company these receivables for shares.
Okay. Thank you.
But until cash comes in, it shouldn't appear.
Okay.
All right. Let me take one more question from the people who have their hand up. I have Mr. Benjamin here. Mr. Adebola has asked earlier, so let me allow Mr. Benjamin also speak. Yes, Mr. Benjamin, my good friend, you have the mic.
Okay, good evening, sir.
Good evening, sir.
Thank you for the good work. Okay, please, I just want to ask a question pertaining to this receivable due from shareholders. So, in case there is delay in paying for the shares issued, would it be subject to impairment?
Exactly, it will.
It will?
It will, yes.
Okay, thank you.
And you and I will agree that sometimes if you subject it to impairment, you might almost create allowance for everything if care is not taken sometimes.
Okay,
yeah.
Thank you, sir.
Yes, sir. Let me take one more question from the chat box. Then I come back to those online that have their hand up before we now proceed. Mabel Tasano said, please, what do you mean by to expense and to capitalize an expense? Great. To expense means that you are going to take it to what they call your income statement. To capitalize means that you are going to recognize it as an asset in your balance sheet. That's what it means. So once you capitalize it as an asset in your balance sheet, you'll be carrying it forward every year as an asset that you own or you owe. You hold rather, every year. But once you expense something, think about it, it's gone. It goes to your income statement and it goes along with that income statement for that year. So it's gone. But once you capitalize an asset, you continue to carry it in your books as an asset in your balance sheet every year. Let me take one more question from the folks online and we proceed. Okay, I think I'll pick Madam Joy. Then after Madam Joy, we'll just go ahead. Madam Joy, you have the mic. I hope you are good. Been a while.
Good evening, sir.
Good evening, ma'am.
So my question is with respect to recognizing assets. A situation whereby the asset was purchased by the owner of the business, not from the business account. So I want to also understand the essence of cash flow. At the end of the day, the cash and cash equivalent should be the same with what you have in all your bank accounts, right?
Exactly.
Okay. So now this asset was not purchased from the company's account. The owner of the business, while he traveled, made this purchase for the company and bring it down. It's an asset and bring it down to the company. I never asked for refund, but we are currently making use of it. So now, if I'm preparing the cash flow, this asset, how do I bring it in as part of financing activity?
Okay.
Investment.
Good question. So from the onset, he bought the assets for the company. Now the question is, that money he used to buy it for the company, did he mention that the company will give him the money back, or he just give away?
No, he just bought it on behalf of the company. He didn't want refund.
So you need to clarify whether he wants refund or not. Most times it's just better in a very structured environment to have an agreement or to have something documented to say this money has been given to the company and the company should take it as equity. Because if he's not going to get refund, it's behaving like equity. But until you codify it in an agreement that is enforceable, you might most likely leave it in your liability. But that aside, your question was on statement of cash flows.
Yes.
Since there is no movement of cash at all, it can never appear on the statement of cash flows.
Okay.
The company did not spend money to buy it. It's not like the owner first sent the money to the company, then the company now uses it. So you will likely not find anything on it in the statement of cash flows.
Okay, so I will as well recognize it in my book, but it will not appear in the statement of cash flow.
Exactly. So in the spirit of fair presentation, in your notes, if that asset is so huge, in your notes to the financial statement, you might need to disclose it under your PPE to say that a certain amount, maybe 50 billion, was purchased on behalf of the company by its shareholder for so amount. That amount did not involve movement of cash between both parties or between with the vendor or contractor. And the amount has been recognized as a liability in note so. That kind of transparent disclosure will be important if that amount is really material.
Okay.
Yes.
So my second question is, when someone mentioned the share capital, a situation where
so sorry to cut in, Madam Joy. So when the item was bought, it was in the name of the company, not on the name of the owner.
No, it was in the name of the company, not in his personal name.
Okay, that's fine. Please go ahead.
Okay. So my second question is a situation where the company when they started the accounting, the ERP that was used, they didn't post the share capital. When you are downloading your financials and then the share capital. So it was nowhere in that in the ERP. So I wanted to incorporate that so that some of those things, those discrepancies I was having, I should be able to. How do I even say it? But at the end of the day, I want to know how I can go about this share capital. Let me say, for example, the share capital is 1 million.
Okay, Madam Joy, this is what we're doing. For the sake of time, I'm sensing that question is not a statement of cash flow question. I'm happy that you have my number. So after this session, just fire me a chat.
Okay.
So that we'll manage our time. Yeah.
Okay.
Thank you very much. At this point, so we don't, I can still stay back and take more questions after 6 o'clock. Like play is 5:20. Before you say Jack Robinson, 6 o'clock, don't knock. So let's go ahead. Okay, just to mention to people who are just joining as well, we are starting a practical training on preparing management accounts. It's happening starting on the 11th of October. It's running till the 2nd of November 2025. The prices are stated there as, pocket friendly as possible. Please do not hesitate to send us a WhatsApp chat or send us a call or a text to find out more and, enroll for it so you can enjoy good knowledge at a pocket-friendly price. If you are getting this type of thing for free, just imagine what you will get when you pay for it. So don't dawdle, don't delay. So let's just go ahead. Now, we talked about operating cash flow being the backbone, the idea. To celebrate it further, to tell you how important it is, the accounting standard IAS 7 puts forward 2 methods for presenting operating cash flows. 2 methods. We have the indirect method, which is the most popular out there in practice. I will share some of my experience with this. And we also have the direct method. Of these two, the accounting standard encourages the use of the direct method. Why? Because it's clear, straightforward. Cash received from customers, so amount, clear. Cash paid to suppliers, so amount, clear. Tax paid, interest, it is clear. Even a villager can understand this. No disrespect to the villagers here. You can understand it. Now, look at the alternative on the left-hand side, indirect method. You have the profit before tax or profit, because the standard did not signify any profit to use. But in practice, most people use profit before tax because that's what the appendix to the standard also uses. So profit before tax, adjustments, because profit is not cash. You then need to adjust it for non-cash items. Remember, hear what I said, profit is not what? Cash. So do not pick up an income statement and say that the company made a profit of 2 billion, therefore they must have a cash balance of 2 billion. Error, wrong. Profit is not cash. Take note. And the reason why there will be disparity between the two is because the process for determining profit is different from the process for determining cash. That's your cash balance. The process for determining profit is based on what they call accrual accounting. The process for determining cash balance is cash basis. If it did not move out of the cash, if it did not enter the cash, it will not reflect in your cash balance. Now, because of the difference between the two processes, profit and cash will usually not be the same. In short, it's so serious that if profit and cash are the same, it's even rare. It's rare to find that. So what it means is that you then need to adjust profit and bring it to cash. Look at that first line called profit before tax here. Then look at the last line, net cash flow from operations. So the distance between this cash and this profit up requires certain adjustments, 2 major adjustments. Adjustment for non-cash items or adjustment generally, and what they call movement in working capital. Inside the working capital items, because working capital is what drive operations. That is why the focus here is on working capital. Inventory, trade and other receivables, and trade and other payables. That's why they pick only these 3. They didn't pick the entire balance sheet. They picked only these 3 because those are the 3 that drive operations. And there's some movement therein that do not relate to cash. That is why we also need to adjust for it before getting what they call cash flow from operations. Now, why do people, despite how clear this direct method is, why do people prefer the indirect method? I will tell you a good reason and a bad reason based on what I've seen in practice. In financial reporting, there is the concept of earnings quality, the quality of your profit. A profit is of high quality. For example, if you have strong performance to show for it, strong income statement to show for it. A profit is also of high quality if you have solid cash to back it up. Remember I said that profit is not cash. So if you are making profit, as you are making profit, you are also making cash. The profit becomes of high quality. So the indirect method will help you evaluate the extent of the quality of the profit that you are declaring by reconciling profit to cash, because now money be fine bobo. Cash is very important in the life of anybody. When money enter, love is sweeter. Cash is very important. That's why they have to reconcile profit to cash. A second technical reason why people prefer the indirect method. Remember the first reason. The indirect method will show you the quality of the profit that the company has generated. High quality profit has good cash to back it up. The second reason why people prefer indirect method is that there are two concepts in financial management, the concept of profitability and the concept of liquidity. Profit here shows profitability. Cash flow here most times speaks to liquidity. And if you understand financial management, those two concepts must be balanced properly. Because in financial management, sometimes if you chase profitability too much, you will lose liquidity. Liquidity means that you have enough liquid resources to pay your liabilities as they fall due, your current liabilities as they fall due. So in financial management, if you chase profit too much, you may lose liquidity. If you chase liquidity too much, you may lose profitability. Therefore, there must be a fine balance. An indirect method will help the analyst evaluate that fine balance that the company is maintaining for their profitability and liquidity. That is the second reason why the indirect method is preferred. Now, the third reason. You see this adjustment, the third reason is a negative reason, and I've seen it play out before. This adjustment of the adjustment movement in working capital, some companies use it to conceal some anomalies behind the figures. I remember early in my career, those years when they used to do IFRS conversion. We were doing IFRS conversion for one company then. At the beginning of the IFRS conversion, we usually share. IFRS conversion means that you are moving from the previous accounting standard, our own is SCS, and you are transiting and converting to IFRS. So it was an in thing then when IFRS came to Nigeria. So there was this client who were doing IFRS conversion for. At the beginning of the IFRS conversion, after we do training for them on IFRS, we will share with them a questionnaire that helps them pick accounting policy choices, because there are some areas in the IFRS where you have a choice, just like this one you have on your screen. There's a choice for direct method, there's a choice for indirect method. At the beginning of the IFRS conversion exercise, these guys picked direct method. Okay, we agreed, you want direct method. When we now started the IFRS conversion, we now found out that their accounting software, their ERP, had malfunctioned, and the balances in the books had been thrown out of correctness. They have become abnormal balances. The balances became so abnormal that when we now prepared the direct method under the statement of cash flows, cash received from customers was giving us a negative amount. Cash paid to suppliers and employees was giving us a positive amount. Tax paid was giving us a positive amount, whereas those figures are supposed to be negative. But because of the underlying error in their numbers, those figures are throwing abnormal numbers through the direct method. We showed it to them and said, look at what is happening because of your accounting software. Do you know what they said? They said, okay, we no longer want the direct method again. We want to change. We now want the what? Indirect method. Lo and behold, when it was plugged into the indirect method, you will not know that there was a problem with the underlying numbers. Everything concealed. So that is one major drawback of the indirect method, and that is one reason why some people like it. It allows them conceal, or it gives opportunity to conceal certain anomalies behind the number. That's why you find the indirect method. I'm not saying that's the reason every time, but that's one of the reasons, which I have also experienced a couple of times. So these are the two methods for preparing the operating cash flow or operating activity. The direct method that shows the cash flow clearly, and the indirect method that reconciles profit to cash. Remember, profit is not the same thing as cash. So the indirect method reconciles the two items. The indirect method also helps demonstrate the quality of your earnings. It also helps demonstrate the balance between the concept of profitability and the concept of liquidity. So the two amounts are expected to be the same. All right, before I project this, I want to pause again to listen to you, to engage with you, to hear your questions. So let's engage again before we move to the final aspect, before we start preparing the statement of cash flows. I think earlier I saw Mr. Joseph Ajayi. His hand was up. I did not call him earlier. Mr. Joseph, if you are there, can you unmute so you speak?
Yeah. Good evening, everybody. Good evening, Mr. Israel. Thanks for
Good evening, sir.
the delivery. We are really enjoying it. I actually wanted to ask a question with regards to investing activities in the preparation of the cash flow that time. That was why I raised my hand. I don't know if I can say ask the question.
Please go ahead, sir.
Okay. How do you treat a transaction where one of the directors, or let's even say the chairman of the board, has been spending some money on behalf of the company, and he is not requesting for a refund, but such money has been treated as a director's current account, like as a liability?
Okay.
One, because the authorized share capital is very low. So they have applied to increase the authorized share capital from the initial 1 million per 1 naira shares to about 100 million. Assuming the money in the director's current account is about 50 million, and he is now requesting that should be treated as his own increase in his share holding to the company, while others will also have their own. In this case, the liability in the director's current account is to be used as his own contribution to increase his share capital. Preparing the cash flow for that year, will it appear as investing activity?
Okay, so first, investing activity is when the company invests, not when the owner invests. Remember, there are two different people. Now, if the owner is investing in the company, the company is collecting money from him. So that means it's not investing to the company, it's more like financing. I don't know if you get that part, sir. I think he has muted. Let me unmute him. Yeah, Mr. Joseph.
Yeah. I meant to say financing. Pardon my use of words.
Okay, great. So during those times when he was spending the money, it wasn't clear, Abi, that it was the equity. Oh, you have omitted again. So in those times when he was spending the money, you would have included it in your statement of cash flows in those years as an inflow of cash from the owner of the business. And you would have presented those items as debt in those years. Now that you moved it from debt to liability, it will most likely not affect your cash flow. Most likely it will not. But there is a disclosure under IS7 where you have what they call changes in financing activities. Let me open KPMG's illustrative. Thank God is the next thing I want to open. There's a certain disclosure. I've forgotten how it's termed, that will reveal this type of thing where you moved it from debt to equity. So it might not show on the statement of cash flows per se, but there's a disclosure of what has happened in your financing activity. Let me see if I can, let me check. So what you have on your screen is KPMG's illustrative financial statement. I will explain what this relates to. Let me see if I can pick out that disclosure. Changes in financing activities. So to answer your question straight up, it will not show as a cash inflow or outflow in the statement of cash flows in that year where you did that reclassification, because indeed cash did not move hand during the year. It was in that year that he paid it. It's in those previous year when he was paying the cash that it will show under maybe as a debt or something. So I'm trying to look for that disclosure. Is that disclosure that will reveal this type of thing where you move something from debt to equity? Aha, this is it. Reconciliation of movement of liabilities to cash flows from financing activities. So it is under these disclosures that you'll be able to see when they are moving something from debt to equity. This is the disclosure that will reveal it. It's required by IS7. But on the face of the statement of cash flows, you will not find it there. You only find it in those years when he actually paid those cash into the business. I hope that answers your question, sir. Beyond the cash flows, you also require some disclosures in your notes anyway. Yeah, Mr. Joseph, I hope that answers your question.
Yeah. It does. It does. You did justice to it. In the years that those money came in as debt, it actually reflected in those years' cash flow. Great. So I just want to know whether if we are moving it will still appear in that year, and you have and that disclosure. I mean that disclosure is important so that one would definitely include it to bring more clarity into
exactly
how the treatment of those transactions went.
Yeah, exactly.
Thank you so much.
Yeah, thank you, sir. Let me pick one person from the chat box. I'll pick another person from the people who ask. If you don't show it, you will not reconcile the cash balance. Remember, it's already in the balance sheet. It will reconcile. Don't worry. It will reconcile. Okay, you said you understand now, right? Olaiton Ebola said, yeah, you are getting the recorded video. Don't worry. You will get it. For a new business, please let me take a moment to take us back to share capital especially. The assumption is that the shareholder has not paid the 1 million share capital, which is sitting in receivables from shareholders as explained. Yes, you are correct. Are we saying both the movement in change the working capital and the share capital will not appear in the SOCF? No, that's not what we're saying. Or just the share capital since the cash has not exactly. So it will show in movement in working capital, but it will not show under share capital. So it will not show under share capital. Let me take one question from the person appearing first here is Sheung Samuel. Sean Samuel, are you there? I hope you are not a Manchester United fan. This one that you are slow in unmuting. Sean Samuel, are you there? Okay. I think Sean Samuel is not there again. Moses Yemi. Mr. Moses Yemi. Mr. Moses Yemi, are you there?
Hello, good evening.
Yes, we can hear you now, sir.
Okay, thank you, sir. So, sorry, I'm taking you back. So, I'm just trying to reconcile this and shareholder stuff we discussed the other time. So, my number one question will be, you said we're taking it to other receivables, but typically, an account, you take it to director's account, and director's account is usually presented under equity. So, in the statement of cash flow, I'm trying to reconcile that example that guy gave regarding the shareholder and the shares and the entry you passed. So I want to know so is it that we are taking it to director's account first? That is the other leg. And if it is director's account, does it mean that the director's account will be under adjustment for working capital? So that's just my question.
So,
I don't know if you get it.
Yes, I get your point. So you are saying this debit entry we are taking to director's account, Abi?
Exactly. That typically anything that
Yeah, it's fine.
director's account, which is
equity. But this is the reason why you have to be able to. There's a dichotomy between a shareholder and a director. Sometimes a shareholder may not be a director, and sometimes a shareholder may also be a director. So that's why I started with these receivables due from shareholder. So if in the case you have painted, the shareholder is also a director, then if you debit this to director's current account, that's fine. As long as when you are doing that movement in working capital, you capture it, that's okay.
Okay, so we'll take. So is it that typically we take director's account under adjustment for working capital?
Yes, that's fine.
Oh, okay. I don't know. Okay, fair. But can you reconcile on the financial position it is equity and then cash flow? We are now putting it under operating, adjusting it for profit. I don't know if you have any.
I'm not sure I understand your question.
So I'm saying director's account on the financial position is presented under equity. But based on what you said now, you said we are going to on the cash flow, we will adjust it under working capital. So I'm saying that you have insights as to reason why on the financial position it is appearing as equity, but on the cash flow we are putting it under operating activity. I don't know if there's
so
any
your question, your question might have some relationship with what Mr. Joseph just asked now. There are some times when your share capital is not enough to cover for the equity that the owners want to put into the business. You went to CAC and you did 1 million, but the owners want to push in 20 million into the business. So your CAC was only able to capture 1 million. Then you started filing for additional increase to 19 million. That 19 million, that is the incremental amount of the 1 million. Most times I'm not comfortable with the term director's current account you use. When you want to show it under your equity, I'll prefer the term capital contribution. And from an accounting process standpoint, there must be a legal agreement backing that capital contribution, showing that I have contributed 19 million to this business on this basis. Once the increment with CAC is completed, that 19 million will now be converted to what? Share capital. I will not collect this money back. It is equity. So those types of agreements are very important to fine-tune the dynamics behind that 19 million. So I'd rather call it capital contribution than call it director's account, because a director's current account is something that can move between debit and credit depending on how the director is dealing with the business. And the best place to take that will either be liability or asset, depending on whether it's a debit or credit balance. I don't know if that answers the question.
Yeah, I get your explanation. So it's not easier when the director pays up like a deposit for share. But in that scenario, it's now the director owing. They've given him share, he's now owing. So, at that point, he has not contributed. In fact, he's not giving share. So, in my head, I'm just trying to reconcile the whole presentation thing that now he's the one owing, right? And you understand? So should it be like, should it still be young? Like, I wanted to know why it will be equity.
In that working capital instead of equity.
And yeah, so I'm just kind of.
Working capital is current asset minus current liability. It is the capital you use to do business every day, the ones that work for you every day. If a customer is owing you money, you call it trade receivable and you put it under current asset. If any other person is also owing you money in the short term, you put it under other receivable, you call it current asset. It also follows that if your shareholder is owing you money, if it is under your other receivable, whether it's director's account or not, it should also form part of your current asset and will typically be part of the movement in working capital in your statement of cash flows. I don't know if you get that point.
Okay, thank you very much. I get it. Thank you.
Yeah, so it's more of the fact that because the current director's current account is sitting inside assets or liabilities as at the time when you are doing that movement. If they had paid for it, it will not sit inside assets or liabilities. You would have collected the money. It will now go into financing activity, pending when it is collected. I sure hope I did justice to your question. But if there's still gray areas, I will drop my number for us to talk better. I think I've taken one question here, one question there. So let me finalize today's session. No, not finalize, Seth. Let me show like the instruction I've been given in that slide. Let me show KPMG's illustrative financial statement. So an illustrative financial statement is something prepared from time to time by the Big Fours and some other mid-sized firms like BDO, Grant Thornton, and even Crowe or Crowe. I don't know if that's the pronunciation. CROWE. KPMG has theirs, PwC has theirs, EY has theirs, and Deloitte also do illustrative financials, but I tend to prefer KPMG's illustrative financial statement. So most times I always advise people that when you are preparing financial statement and you are lost as to how to present a particular item, just download this thing. You can download it online freely. You don't pay for it. So just download the illustrative financial statement of any of the Big Fours. Look at how they presented it in that illustrative financial statement, and it will guide you, to help you a lot in the process of preparing financial statements. So here is a statement of cash flows. This is the indirect method, clearly, in using this illustration. You have the first part, which is the cash flow from operating activities. Like we mentioned, it starts with the profit. Remember I said the profit you are starting with is not defined in the standard, but most people like to start with profit before tax. Here, they start with profit for the period. That's fine. Then you now have these adjustments, just like we mentioned, depreciation, and a long list of, they try to put as much as possible there because it's an illustration. Then the next thing, you have the changes in working capital. You have your interest paid, you have your tax paid before you now have your net cash from operating activities. Here's how the operating activities look typically. If you move to investing, you know what you are looking for, whether they bought assets, long-term assets, or they disposed long-term assets. And as expected, that's what we find there. Proceeds from sale, proceeds from sale of investment, disposal, acquisition here and there, interest received, dividend received. This is a typical statement of cash flows. It's for the cash flows from investing activities. We have the financing activities as well. When we hear finance, the first thing that comes to mind, is it debt? Is it debt or is it equity? So you will see proceeds from share capital, that's equity. Proceeds from issue of convertible notes, most likely debt. Proceeds from redeemable preference shares, debt. Proceeds from loan and borrowings, all those things that we talked about under financing activity. And when you put everything together, you have in this their case is a net decrease in cash and cash equivalent. Simply put, it is saying that at the beginning of the year, they had 1567. At the end of the year, they now have 1170. So there was a decrease in their cash position. What caused the decrease? That is what the statement of cash flows is explaining. These are the things that you spent money on, or these are the things that you collected money for that is driving the difference between this opening balance and this closing balance. So it's a breakdown of how you have spent and chopped your money during the year. That said, we'll go into the final part of the presentation today, and we'll continue next week. Once we are done now, next week we'll continue with preparing the statement of cash flows. So it takes us to the concept of cash equivalent. Not everything you see that is cash is cash. Not everything that you see that is cash equivalent is cash equivalent. So I will rush through this as much as possible. So for cash, the learning is that if it is available for working capital purpose, that's for day-to-day spending, then you can refer to it as cash. There are sometimes in practice, you will have money in your bank account. The company will have money in their bank account and they can't touch it. In practice, they call it restricted cash. Such restricted cash cannot be added to your cash line item in your balance sheet. If you do that, you are committing an abomination. It's just like you are injecting somebody with a AA blood group. You are injecting him with which other one blood group is there? Another blood group. You understand what I'm saying? So you take a restricted cash and you take a cash that you have easy access to for day-to-day needs. You jam the two together. Error. You can't do that. So when you are trying to identify whether a company has cash, always ask yourself, is that cash available for spending for day-to-day purposes? Is it a restricted cash? If it is a restricted cash, the practice I've seen is that it will be included under trade and other receivables. Shocking, Abi? Cash can also be found under trade and other receivables if it is restricted. So there are so many schools of thought around treating restricted cash. I've seen KPMG put it under trade and other receivables before. I've seen some other persons put it under their non-current assets. The most important thing as far as I'm concerned is a restricted cash must not be lumped up as part of your cash balance. That is the cocoa. So when you are preparing a statement of cash flows, remember, not all cash is cash. Some money in the banks may be restricted. You must separate them out of your cash balance. The second thing is cash equivalent. They are highly liquid. They are short-term in nature, most times 3 months or less. And they are subject to insignificant risk of changes in value. That is why Bitcoin is not cash equivalent. And they are earmarked for working capital purpose. We use them for day-to-day activities, those investments. They are called near money. They are at the snap of our fingers, we can convert them to cash and spend them. So when you are having an investment that is subject to significant risk of changes in value, oh boy, you don't have a cash equivalent to treat it as something different. So those are the two important concepts behind cash and cash equivalent. One, under cash, remember, check if there's any restriction on it. Under cash equivalent, how liquid is it and how much risk of change in value is it exposed to? That is why what? Bitcoin is not what? Cash equivalent. And one thing is common with cash and cash equivalent. They must be marked and available for day-to-day needs. That's one thing that is common between the two of them. So let's try out one or two of these. Then we call it a detail next week, Saturday, where we'll come and show preparation of statement of cash flows to the extent time will permit us. So let's try out. So try out one. Let me get somebody to read it for us. Let's do this within the next 5 minutes and we are out of here. So who will volunteer to read it for us, please? Or better still, let me read it since there's no time. So entity A is a property company. During the year, it has secured $5 million of finance, which is ring-fenced for use only for specific development. The funds are held in a designated bank deposit account to be used only for the purpose of the specific development project, which is expected to take 3 years to complete. Withdrawals from the account can only be made with the approval of the lender when specified milestones are met. At the end, 1 million of this fund has been used on the development, and 4 million remains in the designated account. So the question to you, you stumble on this type of thing in practice, this 4 million, how will you treat it? Those in the chat box and those available online. How will you treat this 4 million that has such a restriction? The answer is simple, not to waste time. That 4 million is a restricted cash because it is not available for day-to-day use. It's only available to finance the long-term project. Therefore, the 4 million will not be added to your cash balance. It will be presented separately as what they call restricted cash. I'll just leave it there. There are more trials that you can do on your own. And like I mentioned earlier, our management account training is coming up from the 11th of October. Please feel free to send me a chat so you can register for the training. I'm dropping my number in the chat box. So thank you all for joining today. If you have questions and you want your questions to be answered, you can stay back. I will stay back for another maybe 30 minutes to answer questions. And after that 30 minutes, I'm out of here. Next week, we'll continue with the CAMS framework by preparing statement of cash flows next week. So if you have questions and you want your questions to be answered, please stay back. Otherwise, feel free to go and enjoy your evening. Thank you very much, everyone. Thank you for listening to me. I'm humbled. So let's take questions now. So let's use the next 30 minutes to take questions. Sheung Samuel. I hope you are back. Can you hear me? Sheung Samuel, are you there? I think he just raised his hand up.
Hello, sir.
You are back. Thank you.
Yeah, I'm back. Thank you very much, sir.
Yes, sir.
Good evening, sir.
Good evening, sir.
I think I really appreciate the topic you have treated today.
Thank you,
You
sir.
have done justice to some of the, the technical aspect of it. However, I still want to see how it will roll out by next week. Anyway,
Okay.
My question is this, sir. When you are preparing a cash flow statement for the fourth time in the history of an organization, so how do you balance it up? Quite all right, you might be thinking there is no, cut at the beginning, but of course, there will be some cuts at the beginning. But probably the company has been established for like 2 years. But then there was nothing like cash flow statement. You are just trying to prepare it for the first time for them. So how do we balance it up? That's my question.
Next week, when we do preparation of cash flow, I'm very sure it will address your question. But largely, what we'll just assume that the balances for last year were all zero. That's what we'll assume. So when we do the first step, what I said now will now make sense to you. So when we come next week and we'll come and practicalize, I'm sure at the end of it, even after we now engage after the session, for anyone that you are battling with, I'm sure you will resolve it. That one is even the easiest to prepare.
It should be. That is where we consider that there is no cash at the beginning. But when we know point blank that there is cash at the beginning and we need to balance it up, so that's where I think the confusion is coming from.
No problem. We'll resolve it next week.
All right. Thank you very much.
And even if you have anything pressing ongoing around it, between now and next week, we can always engage offline and see how we can resolve it.
That's lovely. Thank you very much, sir.
All right, sir.
Yes.
Madam Freki Umo, you have the mic.
Good evening, Mr. Israel.
Long time. I hope you are good.
Thank you for always. Yes, sir.
Yes.
Please, my question is around the operating cash flow from operating activities. You mentioned there are two methods, and one of the advantages of indirect method is that it strives to strike a balance between profitability and liquidity. So I know when I see it, where you reflect movements in receivables, inventory, and all of that, but I don't really understand how it strikes that balance. Please, can you throw more light on that for me? Thank you.
Yeah, so when they say in financial management, so indirect method does not strike the balance. No, indirect method is just showing you how the company is dealing with the two, profitability and liquidity. So when they say in financial management, when you chase liquidity too much, you might lose profitability. When you chase liquidity too much, that means you have a high number of current assets. You have high inventory, high receivables. Don't let me put a threshold. Let me just say high. High number of cash in your bank account. You have money tied down because you want to achieve liquidity. You are having a good liquidity position, but if you are taking those monies and invested them in something else, they would have generated income for you and you would have increased your profit. So if you are seeing a company holding so much current assets, it will likely contribute to weaker liquidity.
Profitability.
I mean, weaker profitability rather.
Okay.
Weaker profitability and stronger liquidity. So by the time analysts are assessing that movement from profit to cash, they can easily see that adjustment in working capital and do the analysis easily to see that, this is how much liquidity these guys have chased. That is why the profitability is that much. So that is the perspective. So it's not as if indirect method is the one striking. No, indirect method is revealing it for an analyst to analyze and make more sense out of it.
Okay.
Yes.
I get it. Thank you.
Yeah. I think Madam Gilpin asked a question earlier. You can still leave your hand up, Madam Gilpin, but let me allow Ngozi ask.
Hello, can you hear me?
Yes, loud.
Good evening. Oh, I can't hear you anymore. Can you hear me?
Yes, we can hear you.
Okay. Good evening. Thank you so much. I enjoy your class as always. Okay, so my
thank you. Please go ahead. I'm with you. I can hear you.
Okay, so my question is as relating to.
Is it just me?
Can you hear me now?
Can you hear me now? Can you hear me now?
Folks, if you can hear her, maybe it's from me.
Can you hear me now?
Yes, very clear now.
Okay, I said my question is relating to the restricted cash part. So, what I wanted to confirm, because I think I had an experience one time with doing an audit work. So, what would you say forward contracts are? Are they also like restricted cash?
So forward contract, in the first place, you entered it to maybe tie down maybe an FX rate or something. So in that very instance, you are not dealing with a bank balance. Sometimes you can have an intermediary who holds what they call a margin so that there's more assurance in the transaction. You know, if for example, now me and you took a position that FX rate will increase to 1.6. Me, I took the opposite position and said maybe it will reduce to 1.5, for example. You have taken that position, me, I've taken that position. Somebody needs to come in between to take a margin from both of us. By margin, you take money from me, take money from you. So that if at the end of the day, your position came out as the actual reality at the end of the day, I will not be able to run away with the money. So the person in between will settle the transaction. There's what they call mark to market. I don't want to go into details of all those. So because of the way that transaction is settled, you find out that there's really nothing like a bank account involved.
Yes.
So there's no restricted cash. What you have is what they call a derivative, which could be an asset or a liability, depending on whether the movement is against you or for you. I don't know if you get my point. I hope you have not muted. Hello, Madam Ngozi. Anyways, the bottom line, yeah, open the door. The bottom line is that there is no restricted cash. Open the door, please, go ahead. The bottom line is that there is no restricted cash anywhere. It's just a simple case of forward contract. Giving money to a financial intermediary. Where's the key? I'll leave it at the door, but you can give one. No, thank you. Yep. Yep. So that's it for Madam Ngozi's question. Let me see Mr. Olayemi. Mr. Olayemi, are you there? Mr. Olayemi, are you there?
Hello, can you hear me?
Yes, I can hear you.
Okay, good evening, and thank you so much for the wonderful session.
Thank you, sir.
Very insightful. I think you've answered one of my questions, which is on the illustrative financial. I think you said we can download, and I don't know if it will be shared too.
Yeah, sure, it will be shared.
Yeah, my question centers around two things. I don't know if it will still be treated maybe next week. The first one is how to treat unrealized realized effects, gain or loss. When we are preparing cash flow. I don't know if it's going to be done next week. I can just hold on.
No, please. It will be done next week, but can you see my screen?
Okay. Yes, I can see your screen.
Good. So let me take that one question before we go to your second question. So if the unrealized FX difference is on maybe any cash balance that you have, this way, can you see that this way you present it?
Okay.
Just outside of investing, operating, and financing, this way it will be.
Okay.
Unrealized FX differences on cash. Every other FX difference will appear as part of this your adjustment, as long as it was used in deriving this profit.
Okay.
Come here.
So, sorry, can you still hear me?
Sure, I can hear you.
Okay, thank you. So that means the ones that relate to loans and the likes will be on the other one, the second one that you showed me.
No, loans is not cash balance. So the ones on loans
I'm saying
like
FX difference. Maybe on loan, like, so maybe you are trying to readjust your loan balances and there are FX differences arising from it.
So those ones will be adjusted here in the operating activity.
Okay, thank you.
Remember what I said? What I said was that if the FX difference is coming from cash or cash equivalent, it will be presented outside of the three activities. But if the unrealized FX difference is coming from any other thing, including loan, as long as it was used in deriving this profit, it will come under this adjustment.
Okay, that's very good.
Yep.
Thank you.
Yeah. All right.
So there's concept. My other question we were stressing and it's very interesting about profitability and liquidity. I don't know if you can speak more on that. I understand the concept of liquidity, profitability, but can you just talk more, just elaborate how those things interplay? I know you were saying some things around it when you're explaining the indirect method.
Okay. So when they say a company is profitable, there are different means to assess profitability. Most times we usually use ratio analysis. Then we start looking at how much profit they make for every 1 naira of sale. That's where you talk about gross profit margin and net profit margin and the likes. So for every 1 naira they sell, how much of it is profit? Because anytime you hear sales, inside sales, there's cost and there's profit. It is cost plus profit that gives you selling price. I believe you are aware of all those basic parts, but
Yes.
So each time a company makes 1 naira sale, how much of it is profit? Beyond that, there are still stocks they call other income. So you can have income from fixed deposits, income from those other investments that you might have done. The more cash you are able to push to selling more to your customer, the more cash you're able to push to all those type of investments, the more profit you will have. I don't know if you agree with me.
Yes.
So, but if you have cash tied down in your bank, 50 million, 50 billion, you are looking at it in your bank, you're happy, hey, I have money. You are achieving liquidity, but you are losing on profitability. Because those money that you have tied down in your bank, tied down in your warehouse as an inventory, you could have converted them to cash, deployed them to your customer, make the turnover increase, and make more profit. But you're not doing that because you're just allowing stuff tied down in your warehouse statement. So when you look at indirect method, when an analyst is looking at what has happened with your working capital, he's beginning to decipher, so these people are holding so much assets, so much current assets. And if they are doing this is the amount of profit that they are losing. Why are they doing this? That's the kind of brain interrogation analyst gives himself when he's seeing a company holding bogus current assets at the expense of profitability. From that standpoint, he begins to calculate ratios like asset turnover or inventory turnover, trade receivables turnover, how much they are taking those current assets and servicing them and converting them to sales and profits. So he begins to drill down into those things. By the time he drills down into those things, he comes to a sense about the company. Oh, this company, they have been able, this is how well they've been able to balance profitability with liquidity. It picks another company of a similar size or industry, just the same thing for them. Then he can now do his comparison, side by side. So in summary, that's just what I'm trying to say, that the indirect method will show you, at a glance what is happening with holding too much assets at the expense of profitability at a glance before you now do some further drill down into it. I don't know if that answers your question or comment to some extent. Okay, as muted. Let me see another person that has not asked question that has his hand up. Mr. Felix Igbodo. Mr. Felix Igbodo, we can hear you, but you sound low.
Can't you hear me well now?
You sound higher, but you sound muffled, like something is obstructing the sound from coming out well. Okay. But go ahead, let's see how we can manage it, sir.
Okay, thank you, sir. Thank you. That's fun. Really enjoyed it.
Thank you, sir. Okay.
One, from your instruction, I was okay. You showed the knowledge, your knowledge of this factor. When you talk about, is it the top bottom of when you see you can have, but in that wise, having showed this knowledge, what do you really advise us to use? Direct method or indirect method? That is one.
Okay.
You are not relating it to what you are saying. It's not be related to some of the same. Thank you.
Mr. Felix, your second question, I did not get it. Can you help me type into the chat box? I got the first. Okay.
Now, can you hear me?
Okay, try it now. You can try, sir.
And here now. So we can say in essence that interpret by saying are not relating it to setback. Are not related. They are not related. Are you that?
I am struggling to hear. Just help me send it to the chat box. But I got the first question.
I'm not saying you should relate setback. Can you hear me?
No,
setback.
Okay, so if there's anybody online that had Mr. Felix, okay, nobody also heard, so it's not just me. So, Mr. Felix, you can just throw your question into the chat box. The second one, the first one, I was able to pick it. You said, which method do I prefer? For me, I prefer the indirect method because it's easier to use. But if you think from the perspective of a user of financial statements, I would always give them the direct method. For example, in the management accounts I prepare and review every month, I have both the direct method and the indirect method in that same document. So it's the two I deliver every month. When I'm reporting to the board as well, during board meetings, I also project sometimes earlier on direct method, but much later earlier on indirect method rather, but much later the direct method. And I also observe for myself that that makes more sense to anybody that is not finance inclined. But beyond users, I prefer the indirect method. But when I'm speaking to users, speaking to non-finance people, speaking to the board, I prefer the direct method. So for me, it's not one stone fits all. So if you are here and you interact a lot with non-financial people, I would suggest you use the direct method. If you are here and at some point you report to maybe a managing director, a CEO, the direct method will be your best bet, especially if that person is not an accountant. But if you are reporting to maybe somebody, if you are a senior accountant reporting to a finance manager or a CFO, whatever the CFO says you want is what you will give him. I think that's it. But if you are speaking to non-financial people, please, the direct method is the best. The next other person available here who has not asked question is Madam Gina Okpam. I hope I pronounced that well. Madam Gina Okpam.
Good evening.
Good evening, ma'am.
Thank you so very much for the lectures. It's very highly educating, and personally, I really want to appreciate Accounting Yard generally. I am into finance newly, right? I'm migrating somewhere, and I want to get into finance really. And I'm so glad. I was contemplating at the point which of the platform can I join that will simplify these things to me. And I'm so lucky I ran into Accounting Yard online, when I was searching and then trying to really get myself into this system. I'm so glad. And I have joined Accounting Yard courses, I think about 2 courses, right? When I saw this and I was so glad, right? Thank you so very much, Accounting Yard. And then Mr. Israel for this class. Yes, sir. Okay, my question is, it might be so simple or somehow, but it's a burden to me. And when you were trying to explain it, the network was quite fluctuating at my own end. So my question there is a practical one here. Just a company that was just incorporated, talking about share capital and then equity. The company is just incorporated like a few months ago. And then the first inflow into the account was from the director, who is also a shareholder, 1 million. And then I was just struggling with how do I now treat it in my book, right?
Hello? Hello, Madam Gina. Hello, people. Can you hear me? Okay.
Yes, I can hear you, sir.
Yes, I stopped hearing you from how do I treat it in my books.
Okay. How do I now post this because I just saw the 1 million from a shareholder who is also a director, 1 million naira, right? Like I said, the company was incorporated few months ago. Yeah. And I saw 1 million. It was written loan and loan/capital. So can you just guide me on how I need to treat this? So I will now, when I'm preparing the cash flow statement, I will be sure I am doing the right thing. I don't know if you get me. Hello, sir. Hello, can you hear me? Ouch. I hope I've not been logged out. Hello.
Yes, Madam Gina, sorry, my internet was just misbehaving.
Okay, I was thinking it's from my own.
No, it's not from you, and it's mine. It's logged me out and logged me in. Please go ahead. You said, how do you treat the 1 million naira paid in by the director?
Yes, a director, and at the same time, he's a shareholder. Yes,
Okay.
in summary, I'm asking a company that was just incorporated few months ago. Yeah, they have a share holding. Usually in the CAC document, there's a shareholder, right? Capital. Yeah, but now the company's account has been, activated, and I saw a 1 million naira from the shareholder who is also a director, and the description is loan versus /capital, right? So I'm taking it to be the first capital introduced into this company that was newly incorporated. So I'm now asking, how do I now treat it in my books? I saw when you were I heard when you were talking about receivable and then share account. So can you just run me through or guide me on how to do this? Because I wouldn't want to have issues in the what do you call it, this topic you are treating at the long run. Yes.
Thank you very much for that question. So the first step is he needs to understand that from a legal standpoint, the shares that he has taken up from the business, he needs to pay for it. That's the first thing. He might not understand. Do you know how much shares the business issued to him?
Okay, no, sir. I don't know if you get me. What I'm saying is, the company was newly incorporated. Yeah. Yeah. So now, and the setting up of opening of company's accounts have been, yeah.
He's a shareholder.
Oh yes. Now
the company issued shares to him. Do you understand that bit? The company issued shares to him. That's why he's a shareholder.
Okay. Of 1 million. Yeah.
Yes. So if you look at the CAC document, his name will be there as a shareholder.
Beautiful.
So the summary of that transaction is that before he went to CAC, he didn't have that shares in the company. But they then went to the CAC, registered the name, set up the business. Then once they set up the business became a person of its own.
Yeah.
And once it became an artificial person, he then had the power to issue shares to him.
Yeah, of 1 million.
CAC of 1 million. So once the company has issued shares to him, he is owing the company money for the shares that has been issued to him.
Okay.
That's the reason I'm saying this is because when he was sending that 1 million, he used the term dear loan.
Yes.
As if it's the company that is owing him.
Okay, which is wrong then.
Yes.
Okay.
So he needs to be educated first to say, the company has given you shares, therefore you owe the company money for the shares. Now, these shares, do you want to pay it through cash or through kind?
Okay.
most likely this 1 million that he has sent now, he now needs to be, it needs to be clearly stated that the 1 million is for the shares that the company issued to him.
Okay. So it's called share capital, not loan to the company.
Exactly. You have gotten it. But you must first clear with him so that he will know that that money is not collecting it back again because he's putting loan.
Okay. Okay.
Yeah. And try to ensure that when you are clearing with him, it should be in writing, should be documented so that tomorrow he will not come to say, let me collect the
I
money
gave the
back.
company loan of 1 million. Okay.
Alternatively, I've seen situations where some people will say they want to pay for the shares through kind. If there's any service he renders to the company, maybe as a director or as any service he renders, instead of the company paying him for the service to the tune of 1 million, that amount will be offset against the receivable.
Okay.
So you can pay through cash or kind. But step one, Oga, do you know that these shares you took, you owe the company for it? That's step one. Step two, how do you want to pay for the shares? Do you want to use that cash that you transferred to pay for it, or what is your plan?
Okay.
That is the way to go.
Okay. And he now says that, okay, that is my part of the share into the company. I'm paying for the share into the company.
Great.
Which is the
So
1 million.
So you tell him that that loan in the description is, he has misinterpreted it. It's equity. As he has put it in, he can't collect it back.
Okay. So the right description should have been equity.
Exactly.
Equity capital.
Yes.
Okay.
So what the company now owes him now is maybe if anytime the company generates enough profits through a board resolution and the board meeting, they can approve dividend and pay him dividend.
Okay. Okay.
Yeah.
Okay. Fine. Thank you. Thank you. Thank you. All right, sir.
All right.
Thank you.
You have my number in case you have further questions.
Okay. Can you drop it on the chat board?
Sure, I'll do that.
All right.
I'll do
Thank
that.
you so
Yeah.
much. Thank you, sir. Yeah.
What's the time? I have 3 more minutes before I get out of here. So let me see any other person that has not asked question before. Madam Gilpin has asked, Madam Kina has asked. So John M.
Good evening, sir.
Yes, boss.
All right. Thank you very much for this session. I will go straight to the point. So you talked about, you explained the restricted cash. And so my question is, will fixed deposit be treated as cash equivalent or restricted cash?
So the question would be, is there any form of restriction on the fixed deposit that will stop you from not spending it anytime you need it? If the answer is by restriction, that means even if they are the typical fixed deposit, they will tell you that you can withdraw it, but you will lose some of your interest, right?
Yeah.
If you can withdraw it anytime you like, it ticks one box. It is available for day-to-day cash needs. The second box will now be how much do you stand to lose? If the amount you stand to lose is insignificant, most of the times it is, your fixed deposits will usually be treated as part of cash equivalent. I don't know if that's clear. It depends on the terms around it, and the typical term around it, they will tell you that you can collect your money anytime. But if you collect your money, you will lose certain part of the interest. That's very typical with fixed deposit. So that's why most of the times fixed deposit is usually found as part of cash equivalent.
So that means if there is a restriction on the fixed deposits, it will be it will be treated as a restricted cash.
Most likely, but you then need to dig further. What's the nature of the restriction? You need to find out, because the restriction means that you can't touch it at all. You can't touch it at all for your day-to-day needs. That's the restriction we're talking about. Typically, fixed deposits will have some form of restriction on it. Like if you take it, we'll not pay you half of your interest, or will not pay your interest. But it doesn't mean that you cannot take it. Restriction is saying that you can't even take it. Maybe it's now saying you can't even take it for the next 2 or 3 years. Let me give you an example. Do you use PiggyVest?
No, I don't.
Okay. PiggyVest, I'm doing free ad now. PiggyVest is individuals, they save It's an app where individuals save. So to discipline the individual, there's a feature on Piggyverse that allows you to lock your money for a defined period of time. It's almost similar to what in finance they call certificate of deposits, where you lock that fund with the bank for a specific period of time. Within that period of time, you are not allowed to take from it at all. That period of time must elapse before you are allowed to take from it. There's nothing like if you take, you will lose interest. No, you cannot take from it. If the restriction is that strong, that fixed deposit will likely not make its way into cash. It will likely be restricted cash.
All right. Thank you very much, sir.
Yeah, so you need to drill down. What's the nature of the restriction? Is it like a certificate of deposit kind of arrangement? Even certificate of deposit is of different types as well too. So drill down into the restriction and you'll be able to treat it better. John M. Mr. Olainka Isa, it's been ages. I hope you are good, sir.
Yeah, good evening, sir.
Sir.
Yes, so long time.
Yes, so I hope you are good, sir.
Yeah, so I'm good. Thank you.
Yeah.
Yeah, thanks for everything. So,
yes, sir.
Although I joined this class very late.
Okay.
So yeah. So sorry, there's something that I just want to confirm from you. So
Okay.
if that, because it's one of the the issues I'm facing right now. So there's a particular project that we are working on, and then the firm, or let me say the auditor, before we took over the engagement. So there are some balances in their cash and cash equivalent that which were unable to substantiate, and then as a result of that, when we requested for the last working paper, audited working paper, so before we took over the engagement, so we saw a lot of unsubstantiated balances there. And then we tried to put them on inquiry, and even they cannot even like substantiate. They find it somehow difficult to explain how the balances, how how they come about the balances. And then as a result of that, we have to just like move, because fine, the assignment, the engagement has been like dragging for a while, and they want to like close this project as soon as possible. So, and then at the end, my managing partner now like suggested that fine, we should impair, because that thing, it was, it was giving me the kind of concern that okay, fine, that we should impair that balances since they cannot justify it. Yes. So, and then I want to ask, is it right for us to just impair that such amount, or we should, what do you think we should do?
Okay, even though it's not related to cash flow, but I'll still give my own view. So the first thing
No,
you should
no, we are talking about the cash and
cash bank.
balances.
Okay.
Yes,
You found
so
a way
there's
to rope me in. Okay, no. So what I think first is that you must first send a letter to the bank to request confirmation, to confirm whether these particular banks, when you are requesting from the bank, include those particular banks, that do they have these banks with, do they have these accounts with you? So let the bank respond in the confirmation response. On the strength of that confirmation response, you can now do the impairment or the write-off that you say you want to do. Don't do it discretionarily without writing to the bank. That's my own position.
Yeah, sorry. There's something I want to get right. Are we going back retrospectively to the year that we are not the one that audited it?
So you might not go back retrospectively to the year you are not the one that audited it, but those balances are flowing into the year you are auditing.
Yes.
So for the year you are auditing, you must take. You might
no, we have done the confirmation for that already.
Okay,
but the year before,
did the bank respond to confirm those balances?
Only to the year that we are working on.
Yes.
Yes, we have the confirmation for the year that we are working on. So the issue we're having now is the balances before we took over the job.
So what I've seen, when I experienced something like this, when we wrote the previous guys, in short, it was one mid-sized firm. I don't want to call the firm. They did not respond. And there were some balances that were questionable. It is your audit report that you might likely need to use to respond to that. You can say best for the current year, but your opinion should be structured and worded to lift yourself of any responsibility from for the previous year. So you may want to check ISA around comparative reporting on comparative information. It provides guidance on that. So what I remembered we did then was to say that, look, the current year, the balances we have checked, we have done that true and fair view, but the prior year, we are not able.
Hello? 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 Hey. Hello? Hello?
Hello, sorry, can you hear me now?
Yes, I can hear you.
Yeah, I got logged out again. So sorry, what I was just trying to say is that you might need to reward your opinion with respect to the comparative information. If you are sure that the current year you have enough evidence to back it up, that's fine. But for the prior year, your audit opinion must state it.
Okay.
Yeah.
Okay. And another thing I want I heard when you are like explaining to one of the colleagues in the house that concerning the director's current account, that fine, it may have both debit and the credit, so it all depends. So and then so fine, if we have debit, we know that fine, that one maybe is to form part of our current and asset, and then the credit will form part of the current liability. But from what you said the director's current account should be stated as a separate line item.
Okay, so what I was saying was that there is a difference between the typical director's current account, where the director, you are recording typical transactions between the director and the company. Maybe you owe the director's salary, you book it inside the director's current account.
Yeah.
Maybe you owe the director for dividend, you can book it in the director's current account that you are owing him.
Okay.
Maybe you pay the director for those type of things, you book it. Transactions between the company and the director, typically it will go through that director's current account. Valid, reasonable transactions. In a
Okay, sorry. What about so in this scenario now? So at what point do we regard the director as a related party to an organization?
No, the director is always a related party by default because he's in charge of planning and coordinating the business, in charge of planning and controlling the business. So it's a related party. That one is non-negotiable.
Okay.
So I was trying to distinguish normal transactions, all those ones I've mentioned, with the director, and a situation where the director transfers money into the business as equity, stating clearly that this transfer into the business is equity. Take it as part of equity because you cannot issue more shares to me, given that your authorized share capital is maybe 2 million, but you need more equity. So the director now transfers, maybe for example, 19 billion to the business, and it's stated clearly. In such an instance, that will not pass through director's current account. That will go straight to equity as what they call capital contribution.
Okay. Okay.
You understand? So it's different from a typical day-to-day normal transaction with a director. Those ones is director's current account.
Okay.
But there are sometimes the director can even transfer a lump sum, and he'll state it clearly that, look, this money, don't take it to equity. I've given this money to fund the business for so thing.
So that one will be regarded as part of the borrowing.
Yes, director's loan.
Loan.
Exactly.
Loan, yes.
Or shareholder's loan if he's a shareholder. And all these things, there will be an agreement. I've seen a shareholder loan agreement before. So there will be an agreement that stipulates the rate and everything.
Okay.
Yeah.
Okay. And there's a lady that asked question before. I mean, one lady before you called me, and then the question she was like asking. I think I want to dwell a little bit on that. So that fine, a new incorporated company, and then she wanted to know how to like recognize the share capital. So whether to recognize it as a shareholder loan or share capital. So there was one lady, maybe Ngozi or something like that, that asked that. So she wanted to know the treatment, how to recognize it in the book. I think that was the question she was trying to ask. Because she was like, okay, how do we treat this in the book? So because I know most of the time when we have a new incorporated company like this, fine. The capital injected into the company might not be traceable to bank. Maybe maybe the director funded the capital before the incorporation of the company. Maybe most of the time that money, that share capital is not always traceable to bank account.
Yeah.
So how do we resolve this kind of issue? Should we recognize it as part of the shareholder receivables or what? Or we should put it as part of the under the director's current account? Because that money, that share capital, there's no traceable to it. And that has always been.
Let me share my screen. Let's assume, let me know if you can see my screen.
Yes, I can see it.
Fantastic. Now let's assume it's 1 million naira. At any point in time, this entry must always be passed, whether the guy has paid or the guy has not paid.
Yeah. Okay.
So this entry must be passed. This is what we now hit the share capital. The next question will now be, how did he pay? Did he pay in cash? Did he pay in kind? When did he pay? If, for example, now he paid after incorporation, if he paid in cash eventually, you see debit cash and credit this guy here.
Receivables.
By so doing, it is cleared. If he paid, maybe he rendered the service to the company, a professional service. And instead of the company paying him, take it off from whatever I owe you. So it will be like this. I don't know if you get it. So if now, for example, he now says, okay, I've been paying money before. Take it from the money that I've paid before. You most likely expense it that year. You identify the particular money he wants to take it from. And let's say I paid audit fees before. Well, let me say debit audit fees directly. It might be debit vendor audit fees payable, because you would have first booked the audit fees. So I end up being something like this. So all this depends on how he defrayed that amount that he owed the company. I don't know if any other question before I call one more person and jump back on for you. No other question, Abi?
No, for now, let me also wait to the next class. So,
okay, no problem.
Thank you, sir. Yes, sir.
Yep.
Thank you.
Yep. Madam Kobe, I hope you are good too. You have been waiting for long.
Good evening,
Good evening,
Mr.
ma'am.
Israel.
Yep.
Thank you so much
you are really adding value to a lot of us. I really want to appreciate this. Thank you so very much. I think accounting yard is now my partner in everything.
Thank you very much.
So you can hear me, right? It's raining heavily here. I'm calling you from Kaduna. Okay. All right.
You. Yeah.
So, okay. Now I have two questions, right? On exchange gain, exchange loss or whatever, when you translate your loan, like I have a foreign loan, and at the end of the year we have to like retranslate it, and you have exchange loss or gain. When you were talking about how you are going to treat it on your statement of cash flow, you said for such it's supposed to appear under operating cash flow from operations, right? That's different.
For the FX difference on which one?
And this rain is not even allowing me to hear anything again. I don't know if you can hear me.
I can hear you. I can hear you. Let me send something to the chat box. I can hear you.
Okay. Okay. Please, did you get my question? Okay. So for that now, at the end of the year, what happens? How do you treat it? That's number one. Then number two, you now have you have a domiciliary account.
Alan Kobe, we can't hear you again. Oh, no, the network is not good at our end.
Of course, you're reporting current translating to Naira, and you have that's going to be in this cash flow.
Okay.
Hi.
Okay.
I'm not sure you can hear me. But
I can hear you, but it looks like you can't hear me.
I can't hear you. It's raining so heavily that it's blocking the, I'm shouting as I'm talking now.
Okay, do you know what you can do for me? Record something on WhatsApp and send to me on WhatsApp.
Okay, I'll do that.
All right. Thank you.
I'll do that. Yes, yes, I will. Thank you so much. All right,
you.
Yeah. Yes.
The only other person here who I have not spoken to, this is the last question for today. Olaitan Oyebola.
Andrew, thanks. Good evening.
Good evening.
Yeah, thanks so much. And I must commend you and the, should I call it institute or the team?
Yeah.
Thank you. I think you addressed one of the question I asked earlier, but I was just thinking around it as well. I just thought, okay, let me ask at the end of the class. So it's on this question I mentioned that's on the share capital rather. I mentioned that that's where the share capital has not been fully paid by the director, and of course, based on the last narration you just did now, that will be recognized definitely as a receivable, right? And then that taken into the equity form, the share capital part of the balance sheet, which is still financial position, right? So, but on the cash flow, I was just trying to do a bit of reconciliation. You said that, of course, that would come in again as part of our working capital, right? Which in being the first year, I'm talking from maybe taking a first year of the company, for instance, now. And definitely it's going to be like something like a movement, a negative movement in the nation. But this time around, we're not going to be having, since it's not an inflow, right? We're not going to be having it as part of the financing. But just doing the reconciliation in my head, definitely, I'm just thinking, am I not going to have a balance that would not allow my cash at the end of the period to align, because I have it already taken in as a movement in the working capital section. Changes in working capital section, but in my financing part, I'm not recognizing anything which is new. So wouldn't I be having that difference to my cash balance at the end of the day while presenting in a cash flow? That's just what I'm thinking. thinking in my head just to get that explanation better. I don't know if you get my point.
Yeah, I'm trying to process it. So if we show it as a movement in working capital, but at the share capital end, we don't bring it in as an inflow, you believe that the SCF will not balance, right?
Yes.
Hello?
The cash reconciliation, that's the cash balance. Yes, please.
Okay, so let's leave that to next week when we start preparing the statement of cash flows. At the end of the day, might create a situation where even the movement in that receivables will be adjusted for what is showing up in the movement in share capital. Because as the working capital is also increasing, an equity item is also increasing. So last, that net off that extra throw up in the share capital side will be adjusted against the working capital, so that at the end of the day, nothing must show in financing activity. Don't let me be talking. Let me show you, Jerry. Let me open something to show you. Can you see my screen?
Yes.
Good. Now, let's assume somewhere inside here, that receivables is there. Let me check the notes. This is just an example. Fantastic. Look at this. So we have an example here. Receivables due from shareholders, K of 1525. So first things first, as usual, in statement of cash flows, the difference between these two balances will appear here. Let's just, for the sake of, let's just say movement in, I think I have somewhere where I'd already have a complete, so that will be faster. So here we have the movements in the working capital. Can you see it? That's this one, which is the prior year balance minus the current year balance. Please let me know that you are still with me.
Yes, please.
Fantastic. So somewhere down the line, just hope this doesn't do justice to it. It doesn't do justice to it. Let me continue the way I was trying to explain it. So movement in working capital, movement in trade receivable. I'll say equal to, I would come to prior year minus current year, this. But when we now come to the SFP, there will be an increase of 1 million, for example. Somebody else will come under financing activity. Activities. And it will now say an issue of equity shares. That person will now drop 1 million here. And this will not be correct because you didn't collect this money. So what it simply means is that this 1 million should be adjusted against here, this movement in trade and other receivables, to knock off. I will, of course, let's say this time I would have linked it to a particular note that has it. And this is what will now appear. Why is it not taking effect?
That will now reduce by that 1 million.
Yes, then this one will no longer show under financing activity because you no collect the money.
I get. That was why I was asking that question. Then
it's a good question.
That means both the receivables from shareholders and the share capital will not reflect in that cash flow since both of them hasn't flowed in yet.
Yes. But you know why is careful? I'm careful not to say that is because the movement in trade receivables may not be the same thing as the movement in the share capital. If, for example, the guy paid part of it, you get?
Okay, because it already included okay. You mean for that's including the share capital. I mean the shareholders. Okay, I get. Yeah.
So let's use that 1 million you have said, for example. So we have done the movement here. Abi? So what we'll now bring here under financing activity, out of 1 million, the guy paid maybe 500,000. It is that 500,000 we'll write here.
Yeah, on point. Yes.
Then the remaining 500,000 to make it 1 million will now be adjusted here.
Exactly. That makes sense. Yeah. Thank you so much.
Yeah, I see your cash flow is deep. For you to have picked that, I don't know what you are not supposed to be teaching us, Mr. Ebola. Your cash flow is deep.
Still learning. Thank you so much.
No, Allah, thank you. Okay, ladies and gentlemen, thank you very much for sitting back. All the videos and the presentation slide will be shared with you before we meet next week, because it takes some time to get it out of the cloud on Zoom before we now upload it to the Google Drive. So don't worry. At most, the slide, you'll get it this night. So, and the videos, you'll get that before next week. Thank you very much for your time, for listening to me. I'm grateful. Enjoy your weekend. Bye.